Hello, I'm Justin Boyd, President of Delta Financial Advisory, a registered investment advisor. We provide wealth management and investment advisory services grounded in unbiased analysis of the economic landscape and financial markets, combined with a holistic approach to financial planning. Welcome to our monthly market update video series. We'll review the prior month's economic and market data and provide our thoughts and outlook going forward. If you'd like to learn more about Delta Advisory, please visit our homepage at deltafinancialadvisory.com and complete the contact request form. If you find value in today's content, please like this video by clicking the thumbs up icon and consider subscribing to our channel. Okay, let's get started. Equity, fixed income, and commodity markets all saw notable volatility this month. The new presidential administration also began to implement many of the policies communicated and relatively anticipated from their recent campaign platform. While some correlation of these two short-term occurrences is expected, our general theme for markets at present is simply continuation. Many of the key bellwether inputs to the economy and financial markets remain relatively unchanged from a month ago. Rather, they appear to be simply continuing on their previous respective paths, despite short-term data dependency and political inputs. Our agenda for this month's market update will entail a review of headline economic data, a discussion of a few notable inputs and trends, and we'll wrap up by tying this together in our current asset allocation. On a quarterly basis, real GDP slowed to 2.3%, while current dollar GDP growth was 4.5%. Stepping back to an annual basis, however, the quarterly rate of growth slowed to a mere rounding error. Current dollar GDP on a year-over-year basis was 4.96% and 2.48% in real terms. This compares to 5.03% in the previous quarter and 5.85% in Q4 of 2023. This slowing growth does warrant our attention. However, given a few other critical inputs, such as continued fiscal spend, the nature of the spend and related job growth, along with anticipated efforts from the current administration to produce real private sector growth, we remain reasonably optimistic that current dollar GDP could remain persistent closer to 5% in the near term, barring significant disruptions. Average hourly earnings also display a similar trend, and despite some marginal slowing through 2024, have remained persistently close to a 4% nominal growth rate for some time. Given the Fed's relatively neutral stance at this time, a backdrop of persistent deficit spending, and an unknown true effect of current immigration policies, our expectation is that wage growth continues to support nominal GDP growth rates for the foreseeable future. Broad measures of unemployment and job availability also remain relatively healthy, while broader monetary inputs continue to provide expectation of economic support in the months ahead. One noteworthy mention is the continued trend of healthcare and government being the primary drivers behind the headline job growth numbers. While these jobs are important contributors to the overall functioning of a healthy system, the ultimate impact of that spend versus growth in investment related to industrial capacity expansion is material in our view, with the net effect being a higher inflationary impact as the deficit spending associated with the healthcare system flows directly through to the broader retail economy. Headline inflation ticked back up at the aggregate level this past month, largely due to energy price increases. However, all items less energy slowed 0.1% versus recent months to a 0.2% monthly increase. Additionally, stepping back and looking at several key inflation series on a year-over-year basis, a convergence becomes visually apparent and is a theme we think could persist for some time. Notably, with interest rates remaining at or near current levels, particularly at the 10-year tenor, we find it challenging to support an outright bullish case for the housing market. Rather, our view is that housing increases will remain contained, in line with our larger view that current interest rate policy is reasonably restrictive and will contain future inflation expectations, while not abruptly dampening economic activity. Make no mistake, though, we continue to think broad intermediate-term inflation will remain elevated at or above 2.5%, barring an unexpected economic shock. Surveys of purchasing managers this past month did indicate continued inflationary pressures, and is something we will continue to watch closely. We would also note the already scaled back expectations surrounding Doge, where a 50% achievement of the original target is now being communicated as a healthy, realistic goal. Our recent video entitled Inputs to Sustainability, a review of US budget constraints, dives into the specific impacts different levels of spending cuts could have on the economy. For viewers that may be interested in those details, we'd invite you to watch that video posted here on our channel. Moving on with our continuance theme for this month, we'll review a variety of charts that I hope provide viewers with a broader perspective of where the larger economy and financial markets are likely positioned from a cyclical perspective, and also provide further insights into our approach to managing client portfolios here at Delta Financial Advisory. We will move somewhat quickly through these in appreciation of a volatile but largely unchanged financial market over the last month, but at the same time, take heed to what some of these charts could be indicating. At Delta Financial Advisory, we do not trade client accounts in our discretionary strategies and always take intermediate to longer term views in alignment with our fiduciary duty. However, navigating modern financial markets without a baseline respect for the insights technical positioning can provide fails to maximize the tools in a modern advisor's toolbox, and in our view, ultimately places the strictly fundamental analyst at the disadvantage of some level of timing capability, and simply results in the hope of up and to the right long-term price movement. We'll begin with the US dollar. Note the virtually unchanged monthly price, the test of the resistance level shown in purple, and the ultimate return to weaker levels where the month began. Closely related, we can see the marginal price increase in the 10-year Treasury, while observing a similar pattern where a temporary spike in yields tested critical support levels but ultimately resulted in flat price action by month end. Moving on to commodities. Crude oil had a strong run-up, more or less in conjunction with the temporary spike in bond yields mid-month, but ultimately closed the month only marginally higher. More importantly, it closed back within the resistance levels of larger trends. Similar price action was also displayed in several of the largest energy ETFs in the marketplace today. A second very notable occurrence this month was a rebound in front-month copper prices, ultimately running up to key resistance levels, but experiencing a very orderly failure to break out of current patterns. As we progress into mid-year, the price action of both oil and copper could become quite volatile, and we view both commodities as technically positioned for this heightened volatility that will likely provide additional visibility into the state of the larger global and US economy. Wrapping up our chart segment this month, we'll take a look at two key indexes that had notable price action over the past month. First, the Dow Jones Transportation Index displayed similar behavior to copper and experienced a rally that tested near-term resistance, but ultimately declined to close the month with a still respectable gain. Strong performance by Uber was offset by a month-end decline in UPS related to its relationship with Amazon. Short-term drivers aside, we can step back and notice a very powerful long-term trend immediately apparent. While it's very likely this index will break to all-time highs, given larger macroeconomic and domestic cyclical positioning and uncertainty, our confidence in the continuation of this classic bullish pattern is somewhat muted. This is particularly apparent when viewing the violations of the long-term trend lines this index has experienced in the past. A near-term decline to retest historical support also has a very reasonable possibility of occurring. A second notable index for review this month is the Philadelphia Semiconductor Index. A look at a one-year chart makes the timing of the DeepSeek NVIDIA crash less than simply coincidental, in our view. The index and market appear primed for heightened volatility, and these classic head fakes in both directions as we enter the vertex of this pattern doesn't surprise us in the least. Stepping back to a long-term weekly chart, the pattern becomes even more powerful. You'll note the already elevated positioning as we enter a true decisive point in the long-term pattern. So what does all this mean for investors? We maintain our previously communicated view that elevated equity pricing combined with potential cyclical timing suggests superior risk-adjusted returns may be achieved through continued patience and discipline in portfolio allocation. Further, due to a continuance of elevated real rates and further macro challenges elsewhere in the world, additional credit risk also does not offer attractive risk-adjusted potential in our view. However, we have adjusted our view on duration relative to industry benchmarks and now maintain a more moderate underweight in duration. Thank you for watching, and I hope you gained value from this video. You may notice that some detailed information surrounding our specific asset allocation and portfolio holdings are not shared. This is out of respect for our existing clients. Should you like to learn more about Delta Financial Advisory, please visit our homepage at deltafinancialadvisory.com and complete the contact request form. We offer a complimentary consultation to explore if our investment philosophy and portfolio strategies may be a good fit for you.
The information and commentary contained in this video are for general informational purposes only and do not constitute financial, investment, or other professional advice. The views expressed are strictly those of the individual and do not necessarily represent the opinions of the firm. Always consult with a qualified financial advisor before making any investment decisions. Investments carry risks, including the potential loss of principal. The content is based on current market conditions and is subject to change without notice. The firm is not responsible for any errors or omissions, or for any actions taken based on this information. Past performance is not indicative of future results. This material does not constitute an offer or solicitation to buy or sell any securities.